China's Airbus deal. The blow Boeing didn't see coming. China just dropped a bombshell on one of America's biggest companies. All remaining Boeing orders canceled. Instead, Beijing signed a massive deal with Airbus to 500 new planes, worth potentially more than $50 billion. The message was clear. The United States is no longer China's top choice. And the timing could not have been more deliberate. This announcement landed while former President Donald Trump was still trying to rebuild ties with Beijing, smiling for cameras, shaking hands, and working toward what he hoped would be diplomatic breakthrough with Xi Jinping. For Boeing, it may be the most painful commercial blow in its history. For America, it's a warning that the balance of power in global trade is shifting, and not in Washington's favor. More than just planes behind this Airbus deal is something far bigger. A deeper, more calculated shift in how China moves its money, its trade, and its trust. While Washington continues talking tough about bringing jobs back to American soil, U.S. factories remain idle. The promises of a manufacturing revival, so central to political campaigns over the past decade, are starting to look like smoke and mirrors. This Boeing isn't just about aircraft orders. It's about leverage, who holds it, and how they use it. Because if China no longer needs America, the real question becomes, can America survive the fallout? The Boeing-China relationship. From dominance to decline, this isn't a sudden collapse. Boeing's relationship with China has been deteriorating for years. In 2017, China accounted for roughly 1 in every 4 Boeing deliveries worldwide, over 190 planes. By 2023, just 1, not 1%, not a dozen. One single aircraft. Political tensions after the U.S.-China trade war, safety concerns following the 737 MAX disasters, and crippling supply chain problems eroded trust. Now, with this final cancellation, and Airbus securing China's future fleet, Boeing's position in the world's fastest-growing aviation market looks nearly unrecoverable. Today, more than 1,100 Airbus planes are flying in China, with over 500 more on order. Boeing? Just around 160 in active service. That's not a competition. That's a rout. Why the Airbus deal hurts more than the headlines suggest. It's not just about losing a sale. Each canceled order means fewer jobs in U.S. factories, slower production lines in states like Washington, South Carolina, and Kansas, shrinking contracts for dozens of suppliers, making everything from landing gear to avionics. China's aviation market is expected to purchase 8,000 plus new planes by 2040, worth over $1 trillion. If Boeing is locked out, that $1 trillion opportunity won't flow to Seattle, Wichita, or Charleston. It'll go to Toulouse, France, Airbus home base, boosting European industry for decades. Investors see the writing on the wall. After the deal was announced, Airbus shares jumped nearly 6%. Boeing's stock barely moved. That isn't just a market reaction. It's a vote of no confidence in Boeing's ability to stage a comeback. The ripple effect across America. Boeing isn't just a company. It's an ecosystem. Over 140,000 workers are employed directly, with hundreds of thousands more in related industries, parts suppliers, maintenance hubs, airport services. When orders vanish, the pain travels down the chain. Welders in Kansas lose shifts. Machinists in South Carolina see hours cut. Technicians in Washington state face layoffs. Smaller companies that depend on Boeing contracts start folding. A single canceled plane order can impact dozens of businesses across multiple states, and the fear in corporate America is growing. If China can sideline Boeing, who's next? The corporate China dilemma. American giants like Apple, Tesla, Ford, and GM are watching closely. All of them rely heavily on Chinese consumers or Chinese factories, some for 20% or more of their total revenue. If Beijing wanted to, it could quietly delay product approvals, increase local taxes, steer consumer demand toward non-American brands. And the truth is, most U.S. corporations cannot easily pivot away from China. For example, Tesla gets roughly 20% of its revenue from China. Apple's iPhone supply chain is deeply rooted in Chinese manufacturing. Walking away would mean higher costs, major delays, and huge losses. This isn't just a trade dispute. It's a contest of influence. And right now, Beijing is proving it can flex its leverage without firing a shot. The myth of bringing jobs back. For over a decade, U.S. companies have promised to reshore manufacturing. The political optics are perfect. Flag-waving announcements, cheering workers, headlines about Made in America coming back strong. But off camera, the story changes. Most factories never came back. Many never left in the first place. Instead, corporations expanded in China, Vietnam, India, and Mexico because the math is brutal. Average U.S. manufacturing wage $5,900 a month plus benefits. In China, $1,100 per month. In Vietnam, $400 month. U.S. companies also face higher land costs, strict regulations, and longer permit timelines. Meanwhile, China offers subsidies for electricity, land, and raw materials, sometimes building entire industrial parks just to lure manufacturers. Even logistics favor China. Cities like Shenzhen can design, build, and ship tech products within days. In the U.S., suppliers are often scattered across states, adding delays and cost. The reality? Reshoring is great politics. But for most CEOs, it's bad economics. The American Competitiveness Act, promise versus reality. When the American Competitiveness Act was first drafted, it had real teeth. Companies would only get taxpayer support if they built in the U.S. By the time it passed, those requirements were stripped out. Now, corporations can qualify for subsidies and tax breaks even if they build in Vietnam or Mexico. It's not a loophole. It's an open invitation to keep offshoring. The results are predictable. Despite tariffs and subsidies, reshoring has actually slowed. In early 2025, new U.S. manufacturing jobs announced were down nearly 30% from the same period in 2023. Lawmakers know the consequences. But speeches about rebuilding American industry still win elections, even if the reality doesn't match. China's great decoupling for decades. China's economy was built on exports, especially to the U.S. That era is over. By 2025, only 2 to 3% of revenue for Chinese-listed companies comes from the U.S. China has spent years building trade with Asia, Africa, Latin America, and the Middle East, while growing its domestic market. The result? China no longer relies on the American consumer. In April 2025 alone, exports to the U.S. dropped 21% year over year. By year's end, the drop could hit 77%. Instead of panicking, Beijing is leaning into domestic consumption, now over 65% of GDP, and expanding exports to the global south, where political risks are lower. Meanwhile, America is learning what happens when tariffs no longer bite and threats carry no leverage. The new reality: China no longer depends on America. But America still depends on China for markets, supply chains, and critical components across industries. That imbalance is growing. And so is the risk. The final question: what happens when your most powerful rival learns to thrive without you, but your entire future still depends on them? That's the question now facing Washington, Wall Street, and every American worker caught in the middle. Subscribe now, because this is just the first strike in a long economic war. The next move is already in play, and you'll want to see it before it hits.